Okay, I need everyone to take a breath before we start, because that is what happened to precious metals in January 2026. Is the kind of thing that makes seasoned traders question their entire career choices. I've been watching markets for years. I've seen volatility. I've seen dramatic moves. But what the precious metals market just did was something else entirely, and I mean that in the most unhinged way possible. Let me set the scene. The 1st of January, you are waking up with a headache from New Year's Eve, vaguely checking your portfolio. Life is normal. By the time January ended, silver had rocketed 68 to over $120 an ounce. And then in 2 days, just 2 days, cratered back like it had somewhere important to be at the bottom. Gold broke $5,500 for the first time in history, up nearly 30 in a single month, and then pulled its own disappearing act. 1 month of complete, spectacular, jaw-dropping chaos. And everybody's walking around asking the same question: what on earth just happened, and who is responsible? That is exactly what we're going to break down today. The rise, the crash, why silver went absolutely ballistic in a way gold didn't. And the uncomfortable answer to who was actually pulling the strings during all of it. Let's go. First, let's talk about why prices surged. And I want you to understand that these kinds of moves don't come from nowhere. There is always a cocktail of ingredients that have been simmering for months before something finally catches fire. In this case, the recipe included pretty much every fear-based ingredient you can think of, all arriving at the same time. The setup for January's explosion had been building for the better part of 2025. Central banks globally, and I mean globally, not just the usual suspects, had been accumulating gold at a pace that hadn't been seen since the post-Bretton Woods era. Countries that spent decades trusting the dollar system started quietly, then not so quietly, diversifying reserves. When you have sovereign buyers absorbing physical supply month after month, you create a tightness in the market that doesn't show up, obviously, until suddenly it does, and then it shows up all at once. Layer on top of that the currency situation. The dollar had been experiencing unusual pressure heading into the new year. A combination of fiscal concerns, ongoing debates about debt ceiling dynamics, and a Federal Reserve that had been sending mixed signals about rate direction. Throughout the back half of 2025, when people get nervous about currency, they historically run to hard assets. Gold and silver have played that role for thousands of years. The instinct doesn't go away just because we invented cryptocurrency and exchange-traded funds. Then came the geopolitical accelerant. I won't go into every detail, but January opened with a series of escalating tensions across multiple regions simultaneously. The kind of overlapping risk events that make institutional risk managers start hedging everything with anything that historically holds value during chaos. Safe haven demand hit gold first, as it always does, and the breakout above key technical levels triggered algorithmic buying that added fuel to a fire that was already burning. And here is the part that really matters for understanding the scale of the move. Positioning heading into January. Speculative short positions in precious metals were unusually elevated. When you have a lot of people betting that prices will fall, and prices start rising sharply, instead those shorts get squeezed. They have to buy to cover their positions, which pushes prices up further, which squeezes more shorts, which pushes prices up more. It is a feedback loop that can take a market from notable moves to historically unprecedented move in a matter of days. That is a significant part of how gold went from already elevated levels to $5,500 with what looked like terrifying speed. Now let's talk about silver specifically, because silver's behavior in January was in a completely different stratosphere. A 68 surge is not gold behavior. That is not even normal commodity behavior. To understand why silver does this, why it periodically goes completely feral while gold moves more gracefully, you have to understand what silver actually is. Silver is two things at once: a monetary metal and an industrial metal. It is gold's volatile younger sibling, who also holds a day job in manufacturing. It is used in solar panels, electric vehicle components, electronics, medical equipment, and a dozen other industrial applications. This dual identity means silver responds to two completely separate sets of market forces simultaneously, which amplifies everything. When monetary demand spikes, which it did in January due to every reason I just described, silver gets safe haven buying alongside gold. But silver also had a separate narrative running at the same time. Industrial supply concerns, particularly around solar and battery manufacturing, had been percolating for months. When both demand drivers hit at once, you get the kind of explosive upside we saw. Silver went from a gold adjacent investment to something that looked more like a commodity futures. Squeeze the size factor matters too. The silver market is dramatically smaller than the gold market in terms of total capitalization. Less liquidity means the same amount of buying pressure creates bigger price moves. Think of it like this. Throwing a rock into the ocean barely disturbs the surface. Throw the same rock into a backyard pool, and you've got waves going everywhere. Silver is the backyard pool. When institutional money rotates into silver in size, which happened in January when algorithmic and momentum traders piled in after the initial breakout, the price response is disproportionate to the dollar amount involved. The silver to gold ratio, which had been historically wide heading into January, also played a psychological role. Analysts and retail investors were pointing out that silver looked historically cheap relative to gold, which created a narrative of catch-up potential. When narratives align with technical breakouts and fundamental factors, you get exactly the kind of pile on momentum that took silver past $120. Everyone wanted a piece of the story. Okay, so that is the rise. Now let's talk about the crash, because this is where it gets really instructive. The first thing to understand is that extreme, compressed moves, the kind where a market moves 30 or 60% in weeks, almost always contain the seeds of their own reversal. Not because markets are inherently fair or rational, but because extreme moves shake loose a very specific type of participant, the late buyer. The people who pile in near the top aren't long-term holders or strategic accumulators. They're momentum chasers, retail traders, short-term speculators, people who saw the chart going vertical and didn't want to miss out. These positions are inherently unstable because they're not held with conviction. They're held with hope. When the catalyst for a move starts fading, when the specific fear or specific narrative that drove buying starts to ease even slightly, the late buyers are the first to head for the exits. And when they leave fast. Because they came in fast and they have no fundamental thesis to hold them in place. That is your first wave of selling. In January's case, the catalyst for the reversal appears to have been a combination of factors arriving in rapid succession. Reports began circulating that some of the geopolitical tensions that had spiked safe haven demand were moving toward negotiated discussions. Simultaneously, the Federal Reserve released communication that was interpreted as more hawkish than expected, suggesting higher, for longer rates, which traditionally pressures gold by raising the opportunity cost of holding a non-yielding asset. And positioning data that had shown massive speculative long buildup suddenly became a liability rather than a support. Everybody was long. When everybody's long, there is nobody left to buy. And when there is nobody left to buy, all it takes is a few large sellers to turn the tide. What happened next is what always happens when an overleveraged market reverses. The exits were far smaller than the entries. Margin calls cascaded as prices fell. Algorithmic selling triggered more selling. Silver, being the smaller and more volatile of the two markets, moved faster and harder than gold on the downside, just as it had on the upside. The same liquidity dynamics that turbocharged the rise amplified the collapse 2 days. Back near where it started, the people who got in near the top watched months of gains evaporate in the time it takes to decide whether to sell. Now for the question everybody actually wants answered. Who is the wrecking ball here? Who benefits from this because moves this extreme don't happen in a vacuum? And in every major market dislocation, there are parties on the right side of the trade that didn't get there entirely by accident. The short answer, which is also the honest answer, multiple actors, multiple motivations, and no single puppet master. But the fingerprints are interesting. Large financial institutions that had been accumulating long positions in metals over 2025 had significant gains to protect by January's peak. When you are sitting on 30 to 60 gains in a matter of weeks, the rational move is to take profits. Institutional selling at elevated prices is both logical and, in sufficient size, market moving. This isn't manipulation. This is just how markets work when large players do rational things simultaneously. Hedge funds running momentum strategies had the same profile. They rode the move up using leverage, reached price targets, and began unwinding. Momentum in, momentum out. Again, rational behavior that in aggregate looks like coordinated collapse. But here is the part that is worth thinking about more carefully. There are entities, not always visible, not always traceable, that have historically had reasons to prevent sustained precious metal strength. Central banks and governments have, at various points in history, preferred that gold and silver not serve as persistent visual proof of currency weakness. The academic literature on gold price management is extensive and somewhat contested, but it exists for a reason. Whether specific actions were taken in January of 2026 specifically is something I cannot confirm, and I want to be clear about that distinction. What I can say is that the pattern of the move, the sharp ascent, followed by the equally sharp reversal, fits a historical template that analysts have observed multiple times across decades. What does all of this mean for regular investors trying to navigate a market that just showed them both spectacular gains and spectacular losses within the same month? A few things. First, the structural reasons that drove gold toward and beyond $5,500 haven't disappeared. Central bank accumulation didn't stop. Currency concerns didn't evaporate. The geopolitical landscape didn't become dramatically safer. What happened in January was a repricing event followed by a reversion. But the underlying fundamentals that created the conditions for that repricing are still present. A crash doesn't erase the reason a market moved in the first place. Second, silver's volatility is a feature and a trap simultaneously. Its dual nature as monetary and industrial metal makes it capable of extraordinary moves in both directions. Anyone who rode the January surge to 68 gains and held through the reversal experienced both the thrill and the lesson within days of each other. Silver rewards conviction and punishes momentum, chasing more brutally than almost any other asset. If you're going to own it, you need to own it for reasons that aren't tied to what happened last week. Third, and this is the one I really want people to internalize, leverage is the mechanism by which moderate market moves become catastrophic personal outcomes. The price move in silver was violent, but the people who lost everything didn't lose everything because silver fell. They lost everything because they used leverage to amplify a move they didn't fully understand, and the reversal wiped them out before they could react. The asset wasn't the problem. The size was the problem. January 2026 will be written about in commodity market histories, not because precious metals are irrelevant, but because this is what happens when every fear-driven factor shows up simultaneously, drives a market into technically and emotionally extreme territory, and then, in the way markets always eventually do, corrects back toward gravity. The winners were people who either caught the early move with conviction and managed their exits, or people who did nothing and waited patiently on the other side. The losers, as usual, were the ones who arrived late to the party and forgot where the exits were. Gold and silver are still gold and silver. They've been stores of value across civilizations that rose and fell, currencies that were created and collapsed, and financial systems that promised permanence and delivered instability. That long track record doesn't mean prices only go up in straight lines. January proved that point with brutal clarity. It means the underlying case for owning hard assets as part of a portfolio doesn't change based on what happened in any given 30 days. What changed is the number of people who now have a very personal, very expensive lesson in what a squeeze, a reversal, and a 2-day crash actually feel like in real time. Some lessons cost money. This one, for a lot of people, cost quite a bit of it. Stay sharp out there. I am not a financial advisor, mortgage expert, or licensed financial professional. The content on this channel represents personal opinions only and is intended for educational and entertainment purposes. Please conduct your own research and seek professional guidance before making any major financial decisions. See you next time.